Hello, everyone. Welcome back to our discussion as we pick up on our discussion of those items, those deductions that are allowed for AGI. We left off with self-employment tax, and keeping with that same theme, we have self-employed health insurance. Again, this is someone who has their own business. They can deduct 100% of self-employed health insurance. It used to be a lesser percentage and now is 100%. However, it is limited. If your business is not making money, this may not work for you because you cannot take an amount as a deduction in excess of your net earnings from self-employment. So you cannot have a side business that makes very little money and then have this a deduction offset it because it is limited to how much money you make in that business. And you also can't have coverage elsewhere. You cannot be entitled to participate as an employer. So if you are working for someone and you have your own business on the side, if you can obtain, are entitled to subsidized health insurance, just means that the employer can pay some part of it at work, then you're not going to be able to use another plan that you buy as a self-employed person. All right, so you look at that on a monthly basis. So if you're working, if you have coverage at work for the first 6 months, and then it's not for the 6 months because you lose your job or for whatever reason the employer drops the coverage or whatever, then you could take the self-employed health insurance deduction for the last 6 months of the year or for whatever part of the year you are not covered at work, that sort of thing. So it goes month by month through the year. It does not have to be an all or nothing kind of thing. This deduction's always been there on for AGI. It's usually pretty small. It means you took money out of your CD early and they penalize you. So they're going to tell you exactly how much they penalized you on your 1099 INT, and you're going to be able to deduct it for AGI on the Schedule 1. It's usually going to be a small amount compared to your overall income typically. So, but it is there and can be used. Far more significant amount-wise item is alimony. Now, here's what happened with the new tax law. They made it so that alimony is not deductible for AGI if you have an agreement after December 31st, 2018, okay, or modify your agreement. So if someone has been paying alimony or receiving alimony for several years and they don't make a significant change to it, then they can continue to treat it as deductible. However, if they do a new agreement or change the agreement, you're gonna lose that deduction. There's not going to be a deduction going forward in 2019 or in subsequent years. So that being said, it becomes a little bit important to understand what is alimony. There's 3 different payments that go between ex-spouses or during the process of getting a divorce: alimony, child support, and a property settlement. Only alimony is included, and again, only for agreements that existed prior to 2019. It has a tax consequence. Child support does not. Property settlements was basically dividing up what the assets the two spouses owned. Any transfer of ownership with that is not a taxable event. It doesn't have a consequence on your tax return. So to be alimony, it has to be required by the separation or divorce decree. It must be paid in cash, cannot be in food, can't be in, it could be paid to somebody else, It could be ordered as to pay health insurance or something like that, but it cannot be non-cash. It can't be services or something like that. It has to be required under the law. So I know this sounds crazy, but if one spouse actually pays more than is required to the other one, that is not alimony. So the amount over the requirement does not count as alimony. And the kicker that we sometimes forget is it has to end, whatever the agreement is, it has to end at the payee spouse's death. So the person receiving alimony, if they die, it has to stop. If there's any payment that does not stop with their death, say you're ordered to pay mortgage no matter what, then it's not alimony. So you have to make sure that in the agreement it says that it ends with the receiver's death. And if there's any change in the amount based on the age of the child, then that is going to be looked at as child support, not alimony. Just no matter what it's called in the. So if you have to pay to the ex-spouse $2,000 until the child reaches 18, and then you get to pay only $1,000, the difference between the $1,000 and the $2,000 is child support all along, even if it's called alimony in the legal agreement. So on the flip side, if alimony is deductible for AGI to the one that's paying it, the one that receives it has to increase their income. They actually is included. So somebody is still paying, still including it on that. When for 2019, for new agreements, they won't be deductible, but it also will not be included in income for those receiving it. So if alimony payments change substantially between the first and second and third year, you may see what's called recapture. And basically what the tax law is worried that is you're making property settlements. So rather than dividing up property, you're actually shifting cash from one spouse to the other. And that's why your alimony in 1 year, in first year, is so much higher than in the second and third year. If it's too much higher than the second and third year, that first year alimony can be disallowed as a property settlement and such. So you need to watch that scenario if they're in the first couple of years of a divorce situation. Educator expenses, this doesn't sound a lot of money. They put this in the tax law to kind of give an extra benefit to teachers. We're talking about those in K through 12. $250 for AGI. You're filing jointly, you get $500 if you're both educators, but you still can't be more than $250 for your own his or her expenses. So what's an educator? What counts as a teacher? It's a little broader than you might think. Teacher, instructor, counselor, and principal, or aide, K through 12. But you have to spend at least 900. So that part-time, it's got to be quite, 900 hours. 2,000 is considered full-time. So while that's sort of part-time, that's still a significant amount of hours in a year. And that's an academic year, not a calendar year. But the deduction is during the calendar year. So you got kind of a two thing. You're seeing if you have enough hours based on an academic year, but then the deduction is based on what you paid during the calendar year, because that's how we calculate everything is on a calendar year basis. So what qualifies as expenses? You can see there, books, supplies, equipment, lots of things. They got to be ordinary, kind of things you would expect, and it's got to be helpful and necessary. You're going to probably want to make sure you keep some records of those and what they were used for and that sort of thing if you wanted to take this deduction for AGI. All right, so remember, this is valuable, but in the sense that it's for AGI, but not that valuable in the sense that it's only limited to only $250. So that's not a lot. Uh, uh, Now, as has happened many times before in the tax law, there was a tax law passed on December 21st, 2019, the very end of 2019, after your textbook was published and put back in, and they do this often because things expire in the tax law. They put a deduction in, they say it's going to expire for after so many years, and then they extend it or don't. And sometimes they don't extend it, it expires, and then we wonder if it might come back. And that's what happened with the tuition and fees deduction. So it expired, and now at the end of 2019, they put it back in with the rules from before. So there is more detail in a short reading assignment right after these PowerPoint, these videos, but this is not in your textbook because it was not a deduction at the point that it was sent to the publisher. So it's $4,000 maximum. And this doesn't phase out like some. This is for tuition and fees, and it's limited. Notice it's tuition and related fees, no activity fees, no housing, not as broad as the expenses that count towards when you borrow the money and you do student interest. So that was a very broad definition. This is much more narrowed. It's got to be for tuition, but it's only up to $4,000. So it doesn't take much to spend that much on tuition or those types of things. And it phases out not gradually like the student loan is not a fraction. It's either $4,000 if your income's below $130,000, $2,000 if it's between $130,000 and $160,000, and $0 if you're over $160,000. That's for married filings jointly. All other filing statuses, everybody unmarried is half that. So it does it from if it's under 65, 65 to 80, and over 80 is gone. Okay, so married filing separate doesn't get this deduction. So the second time we've seen that that you might say penalty for married filing separately. Now, being careful, you want, when you're paying for tuition fees and other educational expenses, there are multiple places in the tax law where you can get a benefit. However, they don't want you to get two benefits for the same dollars. So if you claim this deduction for a student, you cannot claim certain tax credits that we'll talk about in another chapter for education. Typically, the credit is going to be better than the deduction, so you want to make sure that you look at which one is going to give the client the best situation that they qualify for. But if you don't qualify for the credit, then you could use this tuition and fees deduction situation. So you need to make sure that you think through all of them. Now, you may have noticed back on our Schedule 1, there is IRA and other retirement-related deductions for AGI on this schedule that we did not talk about. We're going to save that discussion till Chapter 11, where we'll discuss all of the retirement planning issues all together in one chapter, including what your deduction would be for an IRA. But just remember that is there. It's an important deduction. It's a valuable deduction because it's for AGI. It's going to reduce that amount and therefore increase the amount that you can deduct for other things. For instance, just for this example here, by reducing your AGI, you could make your tuition and fees deduction go from $2,000 up to 4,000. If you were right at 130,200, you could make a contribution to your IRA that would reduce that below your AGI below the 130,000 and increase your deduction for the tuition and fees to 4,000 instead of 2,000. See why that's so valuable to the AGI, and why that calculation is so important. There's just one example. So, all right, that should wrap up our Chapter 4 discussion and help us understand where we are for AGI.